Good morning. We'll just wait a minute just for a few more people to join the call. Okay, well, we might get started. So before we begin today, I'd like to acknowledge the traditional owners of the country on which we meet today. I would like to acknowledge the Gadigal people of the Eora Nation as the traditional custodians of the land on which I stand. I'd like to acknowledge all elders past and present, as well as the future leaders who continue their role as proud custodians of the country they belong to. I'd also like to acknowledge our Indigenous customers and colleagues who join us today. Welcome to the NAB Property Insights and Economic Outlook webinar for New South Wales and ACT. My name is Susie Grant and I have the privilege of being your host today. I have recently taken up the role as NAB's Professional Services Banking Executive for New South Wales and head up a team of 10 very experienced bankers here in Sydney who specialise in looking after clients in the professional services industries. Today, we hope that you'll walk away not only with some key insights around the New South Wales and ACT property markets, but we'll also provide a general outlook on interest rates, the state of the current rental market, and also a view on the commercial property market here in New South Wales and ACT. Joining me today on this webinar will be the very knowledgeable Gareth Spence and Mark Browning. Gareth Spence is NAB's senior economist, and in his current role, he provides detailed analysis of the Australian economy and advice on economic developments, both internally to NAB and externally to customers, the media, and any other organisations. A core part of his role is the responsibility for the well-regarded NAB business surveys, which have become a trusted source of information for frequent and detailed information on conditions in the business sector. Gareth joined NAB in early 2018 after 10 years with the Reserve Bank of Australia, where he worked in the economic analysis and research, risk management, and domestic financial markets. Moving on to our second speaker today is Mark Browning. Mark has been head of valuation and property advisory here at NAB for the last 6 years. His responsibilities include residential, commercial, and rural valuations, as well as business valuations, panel management, operations, and valuation risk and reliability. Before I hand over to Gareth, I wanted just to remind everyone that if you have any questions as we go through today's session, to put them into the Q&A box, and we'll look to run through those as part of today's session as well. Now I'll look to hand over to Gareth Spence.
Thank you, Susie, and thanks for the introduction. I'll just pull up the slides for today. All right, thanks. And thank you all for joining today. In the time available, I guess I'd like to just run you through some of the, the really high level, big picture and macro outlooks and the challenges that we're thinking about at the moment, and maybe some of the feedback loops between, the broader economy, the property market, and back into kind of where we think policy may head in the near term. But I guess just starting at the global level, it's quite important for Australia as a small economy to remember that, what happens internationally does impact us, and that obviously wouldn't surprise anybody after the last couple of years. Really, the global context and the global backdrop is, we've seen a very high inflation over the last couple of years. The good news is inflation does look to have peaked globally. It is now easing. It's come off quite notably in a headline sense. Alongside that, rates have risen quite sharply and, at their highest level in over a decade in the most advanced economies, but do look to be at or near their peak in most places. Alongside rising rates and the inflation challenge has been slower growth, but somewhat encouragingly, generally resilient labour markets across the developed world. So, it's kind of the context we face and is playing out in Australia as well. I think a couple of risks still around globally in terms of geopolitical risks, both in the Ukraine and now the Middle East, as well as a slower growth for China. But for now, the global growth seems to be weathering weathering the challenges it kind of faces while inflation moderates. I guess turning to sort of the domestic picture, probably the key thing for us that we're really watching as economists at the moment is the impact on households and household balance sheets, and I guess the flow and effects from that to household consumption, which accounts for around 60% of GDP. So I guess two sort of ways of sort of showing the challenge households face is to look at kind of the mortgage burden, as well as what's happening to household disposable income growth as it's pressured by both higher interest rates and the impact of inflation. So looking at the left-hand side graph, we can see that disposable income growth has actually been negative over the last couple of quarters. In an annual sense, it's fallen by around 3.2% over the past year as interest payable has risen and rates have risen. And the impact of higher prices have weighed on households' real purchasing power. You can sort of see that pretty starkly in the light blue bars where the impact of prices have been quite stark, subtracting around 6 percentage points from income growth over the past year, with inflation at around 6%. You can also see there in kind of the green bars a growing burden from interest payments on both consumer and housing debt as interest rates rise. But offsetting that have been some quite interesting and positive developments. I guess the first one is just how strong labour income has been in a tight labour market with more people employed than ever, stronger nominal wage growth at least since around 2012, and for those who hold assets, a higher interest receivable. You can see that the impact of higher rates is certainly flowing through mortgages to the household sector on the right-hand side, with both scheduled payments and interest now accounting for around 15% of households' disposable income. Its highest level since around 2012, where interest rates were a little bit higher than where we are today. So what are these challenges, and where are we seeing kind of the stress that is showing up, if any, at the moment as a result of the pressure on household balance sheets? Well, somewhat maybe a little bit unsurprisingly, but the younger age groups, those on lower incomes, larger households with higher cost structures, the unemployed, as well as renters have generally reported the highest levels of stress across our consumer sentiment survey. That said, we have seen a bit of an impact across most areas, given the broad-based nature of inflation and the impact of sharply higher interest rates. Again, I guess a little bit maybe unsurprisingly and not news, given it's persisted here for quite an extended period, but consumer sentiment remains very weak around GFC levels, or the depths of the pandemic type levels, in an outlook sense as households face these challenges. And maybe in somewhat of a contrast, but with some similarities, is the NAB business confidence measure, where it's certainly pulled back over the last couple of years, but it seems to have stabilized at around zero, where the balance between optimism and pessimism is matched. Certainly not at GFC or kind of pre-pandemic levels in the same sense as consumers. So how is all of this sort of playing out in a real sense across the economy? Well, unsurprisingly, there is an adjustment going on. Firstly, I guess looking on the left-hand side, we can see, as you would expect, the impact of tighter budgets has kind of weighed on discretionary consumption. It's fallen for 3 quarters in a row, but it does remain high. So, it's certainly come off a little bit, but maybe not as much as feared. Spending on essentials continues to rise across the economy. And again, I guess going back to something we touched on around half a year ago, and what we were really looking for was what's the adjustment in goods and services spending as we kind of came out of the pandemic and continued to recover. So as we all know, we were locked down and services spending took quite a big hit. These include things like travels, accommodation, food services, eating out. They have rebounded and they continue to sort of recover. On the goods side, things have been a little bit more mixed. So have fallen for a few quarters, but appear to have stabilized at a relatively high level for now. Also there, you can just see the pure impact of how strong the price increases have been with the black line and the red line for goods and services, notably above their sort of real equivalents. On the flip side of that, as budgets have been pressured, we can see that households have adjusted in sort of slowing their spending growth, which in aggregate is now quite weak. It's not falling, but it has slowed quite sharply. The flip side of that is households have also begun to reduce their savings rate. So that's not to say they've reduced their stock of savings, rather that, as budgets have been pressured and prices have risen, the household savings rate has declined to kind of its lowest level since pre-GFC, but is certainly still kind of positive for now. So a general story of an adjustment going on in the household sector with slower consumption growth as conditions continue to normalize, but also some impact on the ability of households to save. Looking on the business side and the economy a little bit more broadly, I think our NAB business conditions measure, which in contrast to our confidence measure, has actually held up quite a bit more. So, it's certainly eased over the past year or so from a very, very high level, but business conditions remain above average. So every month we go out and we ask businesses, what are your trading conditions? What's your profitability like? And what are your employment levels? And across those three measures, businesses still telling us things are actually quite strong, or at least quite healthy. And indeed, that is evident across most industries in our survey, including the retail and the rec and personal services sectors, which, maybe are a little bit more impacted by the consumer side. So what is sort of one of the explanations between the difference on the consumer side and the individual level and the aggregate economy more broadly, which appears to be holding up, is certainly population growth. So, the depths of the pandemic, population growth slowed to just 0.2%. We normally grow at something like 1.5, 1.6%, with migration accounting for around 2/3 of our population growth. So obviously, as we close borders to new migrants, population growth slowed very sharply. What we didn't expect was once we opened borders for population growth to rebound just so strongly. So not only has population growth picked up, we've recovered almost all of the 440,000 missed migrants that we couldn't welcome as borders were closed. And population growth has risen to around 2.2% on the official measures to March this year across Australia. Higher frequency measures suggest that the strength has kind of persisted and maybe grown a little bit since then, with some higher frequency measures pointing to population growth of around 2.8% to Q3 this year. Certainly a story that is playing out at the state level in a few ways. For New South Wales, you can see that over the year to March, there are around 153,000 new migrants in the state from overseas. And you can see that overall population growth has risen to around 2% in the state and a little bit more on the high frequency measures. So quite a strong rate, and the strongest in quite some time. For the ACT, a broadly similar pattern. So, international migration has certainly picked up and population growth is kind of rising. But for now, a little unusual trend in the sense that there is still a net outflow from the ACT to kind of other states at this point, sort of weighing on growth a little. Nonetheless, it's picked up to around 2% as well. So, overall, at the individual level, certainly some pressures and stress coming through from both higher rates and inflation as disposable income growth is weak. But in aggregate, strong population growth and I guess a generally healthy labour market still certainly supporting growth. Somewhere else, and I guess the theme of today's webinar more broadly is the housing market. And I think I'll leave Mark to cover much of the detail on prices and rents themselves. But the thing I'd like to sort of remark on is just how surprised we've been, I think, with rates up around 400 basis points over the last year following 12 interest rate hikes. And borrowing power down by around 30% for the average household. We're quite surprised to have seen just such a little adjustment in house prices. So they did fall quite significantly earlier in the piece, but have rebounded quite strongly this year. And I think that's one of the key impacts on the economy of population growth and the rebound in that to date. I guess similarly, the impact on the rental market has been quite stark. So vacancy rates have fallen to very low levels across the capitals, with the exception of maybe Hobart and and the ACT, where vacancy rates have actually risen. But you can see more generally, rents have risen quite strongly on the back of a very tight rental market. Things have slowed a little bit more recently, but generally rents continue to track at quite high rates, with Sydney still quite close to its peak. So the demand side looks quite strong in housing, obviously, with population growth. We've also seen a corresponding or a coincidental sort of slowdown on the supply side, which is added to these pressures at present. So you can see in the top panel here that Australia-wide rolling annual completions of new dwellings has fallen to around 175,000 a year. It's come off a very high level. It is still historically high, but it is a little bit lower than it was pre-pandemic. And I think you can see that quite strongly in New South Wales as well, where completions have fallen to around 48,000 on an annual basis after peaking somewhere closer to around 75,000 pre-pandemic. In the ACT, supply has actually picked up a little bit in a long run sense more recently, to quite a high level, and maybe playing somewhat into the impacts we're seeing on prices and rents in a divergent sense there. So what do we think is the broader story? Obviously, price growth has been quite strong. New housing demand is quite strong with strong population growth. Why have we seen the pullback in kind of new supply? Well, two big factors that have come out of our residential property survey, which will be released next week, is just construction costs and rising interest rates and the uncertainty associated with that. So we can see that in Q3, both of those factors have eased a little bit, but generally they do remain quite high and quite a bit higher than they were compared to pre-pandemic. Looking at official data on the actual construction costs suggests some good news in the sense that inflation appears to have kind of eased as supply chains have normalized and trade has also normalized. But we're yet to really see that kind of correction in the cost of construction products. So, with the exception of steel, generally the price across most inputs has remained quite high, and in aggregate is around 30% above where it was pre-pandemic. Some offset to maybe that kind of slowdown in completions of new dwellings is that we've seen quite a high pipeline of work sort of persist. So based on very high rates of prior approvals pre-pandemic and as programs like the government's home builder program flowed through the housing market, we kind of saw the pipeline rise to quite a high level. Currently around 270,000 dwellings across the country under construction or about to commence construction. That is quite high. You can see in New South Wales, it has come off since late 2018, but is relatively high over the last couple of years, and similarly with the ACT. So, a bit of an offset to that uncertainty and kind of that pullback in construction is that in the near term, we'll likely see some support just from the sheer pipeline of work in train. What's probably a bit of a challenge further out is the slowing in approvals we've seen recently, where the inflow into that pipeline has fallen to kind of its lowest level since around 2012. So as we work through those outstanding dwellings, we would need to see approvals pick up somewhat to kind of match that growth and ease some of the pressures on the supply side in the housing market. What's the net impact of all of that? Well, obviously housing has become quite a bit more expensive. So interest rates have risen very sharply. House prices have risen, not fallen. And what that's meant is the cost of housing is quite high. So PropTrack has constructed a new set of quite nifty affordability measures where they look at what the median income household could have bought in terms of sales over the past year, assuming they spend around 25% of their gross income on housing. And you can see just across Australia, but also the ACT and New South Wales, quite a sharp deterioration. And in fact, New South Wales is now kind of the least affordable state. So a bit of a challenge going forward amidst the higher rates, higher inflation, and the broader cost of living pressures that we are seeing. I guess turning to inflation more broadly, as I said at the start, some encouraging signs. So global inflation has peaked and that appears to be flowing through to Australia. So our inflation rate also is clearly now peaked after rising to around 7% late last year. headline inflation is now tracking around the mid-5s, and we expect it to ease a little bit further. So we think, I guess what we're really watching behind the scenes in what happens to inflation is, as the supply side factors wane and the global factors, so what we call tradables, kind of continue to ease, so the cost of goods we purchase from overseas kind of disinflates or even corrects in prices. What are the domestic factors and features sort of inflation, and what are they doing? So you can see for now the non-tradables component, which typically has a large domestic labor component, and typically in the services sector, has generally remained a bit higher, and I guess not all dependent on wage growth, but a key risk for just how strong inflation pressure remains in a tight labour market. A key positive for the economy over the last little bit is just how strong the labour market has been. So growth has certainly slowed, with household spending slowing and GDP kind of slowing to around 2% annually. But the unemployment rate has kind of remained around 3.5%, which is a 50-year low, and is quite tight. Employment is now over 1 million people higher than it was pre-pandemic, and that comes despite a fall of around 800,000 at its worst during the pandemic. Alongside that, near-term indicators of the labour market actually remain quite robust. So job vacancies are certainly eased from their peak, but they do remain very high. In New South Wales, there are currently 122,000 job vacancies, and that's around 60 to 70% higher than it was pre-pandemic. In the ACT, there are around 10,000 listed job vacancies, which is also around 50 to 60% higher than it was pre-pandemic. So despite that slowing in growth, quite a bit of resilience in the labour market to date. We continue to see wage growth strengthen. It's up at around 3.6 on an annual basis on our best sort of measure, but is not yet sort of a trouble or an inconsistent for inflation to return back to the target. So where do we think rates will go based on all of this? Well, like the globe, we think we're at or near the peak. Officially, we think that we'll see one more rate hike in November, so at the next RBA meeting, with the CPI surprising to the upside and maybe coming in a little bit more strongly than the RBA had forecast just 3 months ago. But really, I think the discussion is rapidly turning to just how long rates are held at a restrictive level. So for now, we've penciled in cuts back towards a more neutral kind of 3% from mid next year. I guess that will really depend on the balance of those domestic pressures in inflation and how they continue to build, for example, with rents remaining strong and wage growth still high in a tight labour market against the easing in inflation that we see globally. So how do we think this will all pay out? So I think a very slow period of GDP growth ahead, so below trend of 1 to 1.5%. We don't see a big recession and a big downturn kind of across the economy, but there is certainly an adjustment going on. And I guess the key dynamic and the key driver of that really will be what happens in the household sector. That slowing in GDP growth will eventually see a tick up in the unemployment rate. But again, we're starting at a very low level. We only expect it to rise to be just below where it was pre-pandemic. And I guess most importantly on that is the rise is really driven by a slowing in labour demand growth, as population growth really remains quite strong, rather than an outright loss in kind of jobs and job shedding more broadly, and the scarring you would see in the labour market on a more significant kind of downturn. As I sort of alluded to, we remain quite optimistic that inflation will continue to moderate. That will help households. It will also see the RBA able to eventually cut rates. We see inflation falling back to around 4.2% by the end of this year, and somewhere closer to the top of the target band by the end of the next year at 3.1%. So I might leave it there and hand it over to Mark to go through the property sector a little bit more detailed.
Thanks, Gareth, and thanks again for the welcome and the ability to join you this morning. Thanks, Susie. I'll just share the slides, and just to orientate the discussion today, I'll certainly be covering on the elements that we've talked about with the overall market, and then spending some time both at a metro, a regional level, and also touch on both the commercial and rent roll sector, given the interests of many of the customers and clients on today's webinar. We know how important property is to Australians, not only for business customers, but also particularly for the natural store of wealth, with Australian housing sitting at 10.1 trillion, commercial real estate at 1.3 trillion. It's the major store of household wealth across the country. If we start at a macro level across the country, you'll see here for both houses and units, both for the quarter and for annual, the rates of growth that's been evident in all the capital cities, but particularly in focus today, the highlighted ones of Sydney and in Canberra. And you can see there, as is often the case, Sydney has started the rebound at the start of the year and now experiencing stronger levels of growth right across houses and units, and continuing to maintain that momentum. Whereas in Canberra, as Gareth touched on, with softer net migration figures and different conditions evident there, that the still in a easing cycle in a large sense, and we'll touch on that in more detail. Really only tentative signs of some recovery occurring across elements and parts of the Canberra segment. We'll cover that, as I said, with some more focus in a moment's time. Again, continuing on dwellings, this gives you broken out for the last quarter each of the capital cities, and a trend on the right-hand side, both for the capital cities and the regional market, showing, as is often the case, the capital cities are experiencing stronger growth there, up 2.5% for the last quarter, whereas the regionals up 1.1%. Sydney in focus, up bottom of the page there, 2.5%. Regional New South Wales 0.8%. Canberra 0.4%, reflecting that modest rebound that I was referring to earlier, is just to close out that picture and to give you a perspective over the last quarter. Markets, as we know, aren't uniform, and they continue to have different price points. I wanted just to give you this insight, but this is the 25th quartile, or 25th is the lowest quartile, most affordable price point in the market. The 75th gives you the top quartile, the most expensive quartile of respective markets. And whilst it was the top quartile that led the rebound in Sydney, that started to moderate more broadly and more recently, and over the last quarter, reflecting at a similar level of growth in both the higher and lower quartiles of the market. It's been the mid-tier that has sustained the strength. In contrast, in Canberra, it's the top quartile of the market that is starting that rate of growth, as was the case in Sydney and other capital cities. That's seen the rebound first, with the lowest and most affordable quartile of the market still experiencing more easing conditions. Sales activity, as Gareth touched on, is important both for property professionals that are on this call today, but more broadly, big flow on into various different components of as part of the economy more broadly. So this just reflects how the 12 months to September is tracked against the year prior. And you'll remember that the year prior was, for most of it, reflected record low levels of interest rates, and at the same stage, a heightened level of sales activity occurring during that period of time. And so it's not unexpected that the rates of sales are off. Sydney off 12.3%, and Canberra very similar, 12.2%. Regional New South Wales off 19.6% on the same 12 months prior, as markets have begun to normalise and return to a more historic 5-year average levels. And you'll see there The regional markets are off 6.1% below their 5-year average, and the capital cities only just 1.8% below the 5-year average, giving you that perspective of the wider history without that 1-year record level of activity that occurred during the pandemic. Sydney in focus. So this really reflects here. Sydney's led the way, as I mentioned earlier. It's continuing to show price growth. Last month up by 1%, 2.5% over the quarter, with annual growth now at 7.3%. So a 10.6% higher position than the trough that was in January. Now at a point, it's only 3.1% below the peak of the market, which occurred back in January 2022. So as Gareth touched on earlier, Sydney has been a market that's shown remarkable strength and rebounding strongly. As I said, there 10.6% over the course of the year is really strong growth in what is otherwise a challenged broader economic situation with interest rates and household affordability concerns more broadly. The bottom of the page reflects the position for the month, the quarter, and the last 12 months for dwellings, which is a combination of houses and units. Middle of the page there, houses and units on the far right. Just to give you a sense as to those underlying key components. And perhaps the other one to really call out, centre of the page there, total listings are down 4.8 on the same time last year. That's down 4.3% on a 5-year average. So, reflecting there's still not as many options as there historically has been in Sydney. New listings, however, which is what we've seen a lot of media attention about more broadly and more recently, is up 32.1%. On last year, but if you compare that with a 5-year average, it's actually 8.5% above a 5-year average, and shows that there's some early signs there of more options for potential purchasers. We're not seeing any significant signs of forced selling or distressed situations in that as yet, but something obviously given the market we're attuned to. And as I said, sales down 12.3% on the same period prior. Average days on markets, a lead indicator on the market performance, have tightened from the same period last year, so just 29 days. Vendor discounting still pretty modest there at 3.3, so again off the same period last year. And annual growth in rents. Gareth touched on the record low levels of vacancy in rental properties around the country. Sydney specifically continues, and that has resulted in a steep level of rises there. Houses up 8.4 and units up 14.3% for the year. All macro Sydney specific information. If I go to a more localised snapshot, this is the Sydney local market areas for the last 3 months, and shows you the deeper the colour of blue, the more the rate of growth that has occurred in that particular pocket of Sydney. And if you see any pockets of pink or red, that reflects prices easing in those particular markets. And as you can see across Sydney, not really evident given the strength of the market that's been occurring as the growth phase got underway from January earlier this year. If we present that in a tabular format, again picking up the SA4 regions here, giving you both the monthly change and quarterly changes across those pockets and across those markets across Sydney to help you identify your local market or areas of more specific interest. On the right-hand side there, just a couple of remarks around rental value growth at a more localised level. Selling days, again, 25 days quickest and out to 41 in some and in rides. So a range of experiences there, and sales activity across different markets in Sydney as well, which is perhaps best displayed on this next chart, which reflects annual sales activity across the different markets of Sydney on the same period of the year prior. Always important to look at the regions, and so what we've shared here is across regional New South Wales monthly and quarterly price movement that's been occurring, and it absolutely is fair to say that regional New South Wales has not experienced the strength of price growth that has been occurring in Sydney. You'll recall that when the first instance of COVID came, there was a big flea of activity from capital cities. Sydney was no different, and an influx to the regions that drove prices very high, and a fast rate of price growth at that period of time. That's taken some time to consolidate, and naturally and historically, it's always lagged capital cities in price growth. So not an unexpected experience there, and you'll see on the right-hand side just some remarks again around the different regions, and both from our rental values and activity, as well as from days on market as well. Just to round out our picture in New South Wales before we move to the ACT and Canberra specifically, just a couple of remarks around commercial and some of the key asset classes in that space. In industrial, we've seen continued upward pressure on rents, and available land is very tight in Sydney, as we know, and that's seen continued strength occurring. And whilst the interest rate adjustments over the last 12 months, 18 months have also flown through to the yields applicable for industrial property, largely the unwinding of those rates has been offset by the rental price growth that's been occurring. Still a steady flow of transactions, both in the mid-market and below level, with owner-occupiers looking to enter in the market and gain surety around their supply or their availability of property, particularly given they've been subject to rent increases as well. So people taking that option into their own hands, as well as the usual level of business activity that is reflective of this stage of the economy. Retail, perhaps a little bit more mixed there. There is absolutely some evidence of tenant demand, particularly at the luxury end of the market, which is still performing relatively well. CBDs is I wouldn't describe that as back to its full strength, and we've followed the rates of return of people back to office and the patterns that's resulted in traffic flow and movement across city areas. Whereas in the suburbs, some strength still evident in those locations. And more recently, as interest rates and household budgets have become under pressure, some divergence in how those that are focused, those retail properties that have tenants focused on discretionary versus non-discretionary sales have also become evident as they've been performing as well. There's been lots of column inches and media and social articles on the office sector, both in Sydney, which is the benchmark for Australia, of course, but also globally, as we've been tracking those that have returned to the office, the discounts that have been applicable as that sector's unwound, discounts or reductions in space, the lift in vacancies and the lift in incentives that's been required. A number of the real estate trusts that have also been needing to, and have elected to take their properties to market, some of which have also been holding back. So it's been a sector of significant interest and still some way to unwind in our view as patterns around occupancy and patterns around space requirements still to work through, as well as the flight to quality that's been evident from properties that have not got the same appeal for end of trip facilities and other amenities as tenants have looked to upgrade and use that also as one of the ways to attract people to come back to work from office versus working from home. So a sector that is creating lots of interest, but also one where there is still lots to still unfold over the coming 12 months or so. You'll see there the what's evident from a effective yield perspective on screen there, bottom right, and as you can see around Sydney, still more space to come to market, notwithstanding some of that secondary stock discussions around conversion to housing, conversion to hotel. It's not a lot of progress as yet in that part of the transition at this phase for the office cycle. I think it's only important to also share how rent rolls have been performing and some insights here that I won't labour, but wanted just to really highlight briefly. We've continued to see activity for succession purposes as vendors retire and as transition occurs. There's a continuing theme around large entities bulking up and making strategic purchases as well. And more broadly, as many of us would be also evident, is the sale of some investment properties and the implications of that around rent rolls, but offset with that rental price growth that we were just discussing a few moments earlier as well. If I turn now to the Capital Territory and just share some remarks here, similar format again, bottom of the page reflects of what's been happening over the month and quarter and annually for both dwellings, houses and units. And it's largely been the unit market in Canberra that has been moderating the value growth and also reflecting that the level of stock that's still flowing through in that particular space as well. So for the month of September, dwelling values, but it's houses and units, gained 0.2%. Whilst overall dwelling values are 0.9% above the trough, they are 7% below the peak value that's occurred. The days on market are steady, but it's still one that we should be continuing to watch. An annual vendor discounting, similar levels, slightly less than this time last year, but annual growth in Canberra rents has been easy, and so that's off 4.1% for houses and a little bit less at 0.3% for units. That's been evident over the last period of time. From a listings point of view, total listings up 14.2%, and it's up 11.3% on a 5-year average. So there is a sizable uptick there in numbers of options for purchases, which is putting moderation to the level of growth that has been able to be achieved in the Canberra market. If you look at the regions, you'll see there the pockets that are performing more favourably than others across Canberra. And with that picture to close out with, Susie, I might hand back to you and be pleased to take any questions that you might have.
Excellent. That's great. Thanks, Gareth, and thanks Mark. That was really informative and heaps of information in there, which is exactly what we're here for today. So I think we've got a couple of questions in the Q&A box. So just a reminder, if you do have any questions, just to put them into there and then we can look to address those to start with. So I'll start with the first one from Priya. So as renters are under pressure, what's the current and forecast supply of the rental market and how much higher can rents increase? What is the expectation or forecast here?
Yeah, maybe I'll jump in first and Mark can follow that up.
Perfect.
I think it's a bit more of the same for now. So I think generally think of this as a whole, right? Not just the rental stock, but also the housing stock. And it's a good question because it reminds me to sort of answer this part. But we've seen that supply has come off. I think unless we see approvals pick up, we're probably not going to get a very strong response in supply as that pipeline is eroded at the moment with population growth the way it is across the country and the slowing. We have a gap of about 50,000 dwellings kind of per year, so it's not quite that literal, but at face value there is that sort of shortfall. And I think it sort of goes back to some of the trends we're talking about in terms of regional areas and reversing the trends to kind of moving out of the cities and average household size and share housing and things like that will ease some of the pressure. But for now, it does look like rents growth will remain quite high. It has eased a little bit, but it's still very high, and it looks to kind of remain that way with with rental vacancy still quite low.
Yeah, just perhaps to add to that, I don't see the supply coming on quick enough to be able to really address that in the shorter term. So yes, definitely support and agree with Gareth's perspectives there. It will really be a factor of, does that get beyond what consumers can bear? Do they have to move back home with mum and dad, or reoccupy the granny flat or downstairs rooms? And that's probably when you'll start to see any change in that space. I mean, there's a little bit of evidence of that, Susie, but nothing significant. Mm-hmm. And with still net overseas migration adding to the demand, there's still pressures that are evident, particularly a Sydney-based comment in that perspective, Susie.
Excellent. No, that's great. Thank you for that. I've got a question here from Andy James. Does NAB have a view on converting office buildings in Sydney CBD to residential to help ease housing pressure? Do you think this will happen in the next 1 to 3 years? What are the barriers? And thank you.
I'll have a first crack at that one, Gareth, and please feel free to add to that. Look. At a macro level, that seems to be the simplest, most logical response. It's not quite that easy, otherwise it would have already been done. Typically office buildings have large floor plates, whereas residential apartments have smaller floor plates, increased use of natural light. So not all commercial buildings, not all office buildings are suitable or easy to convert. Feasibilities aren't fully stacking up to do the conversion at the moment, as well as some of the challenges still from a planning perspective as well. So there's a couple of things that are still headwinds in that space. If we sat here with a magic wand, that would be the reaction or the response that you would potentially play. There's definitely a little bit more evidence around conversion to hotel style or serviced apartment style of activity, but again, it's relatively small at this stage. Andy's probably right in the sense of I wouldn't expect a quick response. It's more a 3 year plus type horizon to achieve that. And trades are really in hot demand still, and that's another factor. You just can't get trades to be able to do some of this as well. So that's another piece of the headwind that's making that response a challenging one. But other than renting out, any spare rooms in people's houses, it seems to be, from a headline perspective, a good area to focus on and target, but just not easy to deliver, Susie.
Okay, excellent. Beautiful. I've got a question here from Gunther Stenzel. So Gareth, your slide 12, what's your outlook on where disinflation on building costs would come from, given stronger for longer tagline on the US dollar, and also skilled labour constraints and unfavourable weather events continue to impact, and in what magnitude and timeframe?
Yeah, it's a great question, right? So, kind of we look at it from multiple angles, but a big question we have in the CPI sort of more generally is what happens to goods prices for us. At its peak, building costs actually added around 2 percentage points to that peak headline CPI of around 7%. So something we do watch pretty closely. It's unclear whether prices will fall. We've certainly seen kind of the inflationary pressures ease as sort of, global supply chains have recovered and those sort of things have kind of ease the pressures there. I think you're sort of correct in that the next challenge probably really is the labour supply. So job vacancies are still pretty high, even in the construction industry. But, the unemployment rate is low, kind of economy-wide. Our business survey says, around 80% of firms are still reporting some difficulty in labour. Around 40 are still reporting significant difficulty. So, I think that is sort of the next challenge for construction is really the labour market side. We've seen some raw materials certainly ease, like timber and maybe steel for a period there before the sort of recent resurgence. But I think that's what we watch pretty closely. I think demand is quite strong still, and that will kind of support prices. And it is the challenge. It goes back to the question of kind of the office conversions and conversions more broadly about where does the supply kind of come from. I think that is kind of the challenge. What is our capacity in a labour market sense and in a material sense to kind of build out what we need.
Excellent. Got a question from Priyanath again. So Mark, in relation to boarding houses and considering the rental market is tight, what are your thoughts on the outlook of these in the property market?
Yeah, it's a good question, Susie, and certainly, it's been a big 12 or 18 months for boarding houses more broadly, and with whether it is the return of international students to Sydney and immigration more broadly, they're all drivers, factors in this space, and as Gareth was just touching on, there doesn't seem to be any significant resolution, imminent in sight. So I think that those same remarks would hold true for this sector as well. You can expect pressures, tightness in this space until that broader response and additional supply comes to market as well, Susie.
Okay, excellent. Thank you. I suppose I've got a question. As a banker and with NAB, a lot of the times our conversations with our clients is all about interest rates and what's happening and what's sort of our thoughts for the future. So probably a question for you, Gareth, is, what are the risks to rates in the near term and the long term from your point of view?
Yeah, look, I think, we've seen a very sharp increase in rates. We probably haven't gone as high as some other countries. We know that there's few differences, and one of those big ones is in our property sector. Most rates are actually variable, so despite that kind of big lumpy fixed rate sort of roll off we're going through now, rates actually pass through quite quickly. So it's a bit of a balance. I think we are near the peak. We think they'll do one more, but ultimately I think the question is how long do they stay at that level. So we all think rates are kind of quite restrictive now. We're starting to see that impact on activity. I think it's really important to remember that, policymakers don't operate in a vacuum. So, they're not hiking blindly until we go into a recession. It is important to kind of remain kind of optimistic. And I think, in the near term, sure, I think maybe there is probably more upside than downside to rates, given we just have a little bit of uncertainty of how that services sector kind of inflation plays out as the global factors wane. And we do know the labour market's pretty tight. But further out, I think a bit of a lesson here is that the longer the economy stays resilient, which is a good thing, rates can also sort of stay high. So I know it's been quite the adjustment over the last 18 months or so, as Mark said, but historically rates are actually still relatively low. It's just that we've come out of a pretty unusual period. So I think, I think we will tread Phil Lowe's kind of so-called narrow path. Maybe it's a little bit wider than narrow at this point, and I guess it's important to kind of remain optimistic. But I think, eventually we will kind of get through this without a big sort of downturn, and eventually we'll see rates kind of come back towards something a little bit more normal or more neutral. So kind of something like 3% from 4% where they are now.
Okay, excellent. Thank you. Got another question from Gilbert Fan. Sydney housing price at a relatively high historical level now. So how far will this go within the next 12 months, given the population growth, foreseeable high interest rate level through 2024, to potentially put more pressure on mortgage repayment, under supply housing level, and etc.?
Do you want to take that one, Gareth? The official view?
Yeah, I mean, Mark's views are always welcome in these things, but I think it's a good question. I think, like as I said, we're quite surprised in a sense at the resilience in house prices, but then when you look at the migration, the demand side, and the balance with supply, maybe it's not so surprising. I think a bit of its sentiment. We are a little bit more, let's say, certain that rates are near their peak. We know they're not going to 6%, for example. They might go a little bit further than where they are now, but I think that will restore some confidence. And as activity comes back, we may see some more upward pressure. I don't think the demand side and the migration story is going to ease too much anytime soon. As certainly as Mark said, it's quite difficult to just turn on supply, particularly in the volumes we think we need. So, the balance for now looks like kind of an upgoing, pressure on prices. I think, our forecasts have been revised up a little bit recently. We think we'll end the year around 9 to 10% up over this year, and I think we think growth will slow a little bit next year, but ultimately we'll end up around 5%. So I certainly welcome Mark's views on some of those magnitudes, but it doesn't look like we think house prices will fall in the near term, let's say.
And I think the earlier those rate adjustments occur in the year, or if there was the circumstance where there wasn't a further uptick, I think that's probably provides just that level of upside risk, if you like, to those types of numbers. I think there is, from our market insights, people sitting on the sidelines waiting for a little bit more certainty to make those decisions. So once that became a little bit more evident, I think that would potentially have an add to that momentum that's clearly underway in the Sydney market specifically now.
Okay, that's great. Thank you. Excellent. Now, was there any more questions that people wanted to ask? Beautiful. Okay, so on that note, I just want to say I've got one, last one from William Chen. Do you think the regional property will fly?
In a brief nutshell, not to the level that it has, Susie. That was it was a record level of growth that occurred in regional New South Wales during that pandemic, and record low levels of interest rates. So 20, 30, 40% type growths that were occurring in some locations. That's not sustainable, not even healthy for those local communities to be able to still buy properties in those locations. So I'm still a subscriber and still have a view that there will be continued people working remotely, commuting from whether it's the Gong or Newcastle or other locations, or working sometime in the city and sometimes out down the south coast and the like for Canberra, etc. as well. But I'm not sure that the level of price growth will get back to those types of levels, Susie. So I think it's a transition at the moment, and a more measured and sustainable level of activity that would be more anticipated over the next 12 months.
That's great. Thank you, Mark. Okay, so we might just look to wrap it up now. So We just hope today has provided you with some further insights on the current state of the market here in New South Wales and ACT. So I think I've already had a question on this, but just for your information, we have recorded today's webinar and this will be distributed next week for you. So I'll just go through to your email. So any questions, please reach out to your NAB banker and they'll be more than happy to help. There's also a small survey at the conclusion of the webinar. So if you could please fill it out and provide your feedback and also any suggestions on what you'd like to see in the future Property Insights webinars, that would be really greatly appreciated. Thanks again for spending an hour with us today and look forward to seeing you next time. Have a great day. Thank you.
Thank you.